Hello and welcome. This is Vanessa Growlish, and today I want to show you the 4 financial statements. We're going to talk about what is the balance sheet, what is the income statement, what is the statement of cash flows, and what is the statement of owner's equity. So let's start. So I made, let me go ahead and just share the screen here because I have everything already written here. And let's start understanding what does each statement does. Today is just going to be basically like a basic knowledge, and then in another video I will go very deep into this, because not only is fascinating, at least if you are like someone that likes finance and likes to read financial statements, I think it's fascinating. But I also think, like, for people that want to understand this and you just don't know where to start, I'm going to tell you it's very, very simple. The math is just plus and minus. All what you have to know and understand, if you're not a finance major or if you're not comfortable with these terms and you decide today, I want to have my own business or I want to invest, where should I start? Well, the first thing you should start is, what is the income statement? What is the balance sheet, the statement of cash flows, and the statement of owner's equity. So first, let's start with the income statement. And now, what is the income statement? Well, the income statement, what basically shows you, and then I'm going to put an example here in the screen, is how profitable is the business. Why? With the income statement, this is where you're going to report your revenues, and I'm going to give you an example, minus just your expenses. Now, let's understand what is revenue. If you have revenue minus expenses and your revenue is higher than your expenses, you're good. That means that you have a net income. When your revenue is less than your expenses, so if your revenue is less than your expenses, this is when you have a net loss. Now, the income statement might have sometimes months that are good, where you show a net income, and then the income statement might show months that you have a net loss. Is that good or bad? Well, sometimes your business is more profitable in some months more than others, and that's okay. And if you're an investor, for example, when I had the tutoring business was very profitable because the revenues minus the expenses were good during school time. However, when the summer came, my expenses were the same, because you're going to have variable and fixed expenses like rent, electricity. Especially, I had the tutoring center in Miami, and the electric bill during the summer was much higher than during regular times, and I was generating less income, to put it away. I was generating less revenue. So very important, when you hear someone, oh, I made this much money, you should ask him, was that profit or was that revenue? Because revenue, for example, let's say that I was tutoring and I had like all of the students coming, and basically I was just doing tutoring hours times hour rate, and that will be my revenue. But if I had, let's say, like, I'm just putting an example here, $3,000 in revenue, but my expenses are $5,000, well, I'm going to have a net loss of $2,000, right? The idea is always to make sure that you control your expenses, because they're more controllable in a sense than what you can get on your revenue. Because, like, for example, COVID is killing businesses. Why? Because they're still having the same expenses, but the revenue, if you had a restaurant and the city is telling you, we're not going to give you a tax break, which something has to happen with that. However, you can keep your restaurant half open for whatever the COVID restrictions. Well, as a business owner, you're going to say, wow, but my expenses are probably half of what my revenue is. So this is the problem with situations like what we're having right now with COVID. Let's move on. Now, the income statement, what shows is how profitable is the business, because profitability means is what, like, the chance, like how you're moving your revenue and expenses every month. So sometimes when I had the tutoring center, the income statement, not sometimes, in general, because I had the tutoring center for 10 years, my income statement will be good. And then during the summer, we'll have a peak down. So if I wanted to talk to a lender, I would have said, okay, here are my income statements. And if the lender would have seen the income statement in July, which it was the worst month, and I don't know if other tutoring businesses had the same, but I'm pretty sure that it was the same pattern, they will be like, but then I will be like, wait. Look at my income statement in January, February, and so on. And then showing them the income statement all the time, for 12 months is exhausting. So this is when you say, not a problem. Let me show you my balance sheet. Now the balance sheet, what it shows is how much in assets the company has and how much debt the company owes. Let's understand what are assets. The difference between assets and revenues, that revenue is the money that you're generating by doing a service or selling something. But an asset is something that you own. For example, when I was doing the tutoring business, what were the assets of the business? The computers, the furniture, the books, the calculators. Those were my assets. What was the debt that the company can have? Well, for example, if I wanted to get another 5 computers so other 5 tutors could work, I could be like, I'm just going to go ahead, go to Best Buy, get a line of whatever, like a credit card, right? And just get these computers. When I get these computers, even though I'm getting them with credit, that will show where on the balance sheet. The lender is going to say, oh, she just bought 5 computers because we see them under the liabilities. But at the same time, they're going to say, oh, but those 5 computers are also an asset for the company because with those 5 computers, then now she's going to be able to generate more revenue, right? And obviously my expenses are also going to increase if you think about it, because now I'm going to have higher electricity costs. I'm going to have to get more furniture for this, for the tutors to sit down. So as you can see here, the balance sheet shows that. And I'm going to show an example how the balance sheet, the difference, how the income statement and the balance sheet shows in a simple example. Then from there, I'm going to have the statement of cash flows. Now, when I had a tutoring center, I had different ways of cash coming in. The first cash was from tutoring, right? But I also had my YouTube channel. I also had the book. So basically, that was also, cash flow that was coming in. So if I had to go to a bank, they will say, okay, how are you generating cash to pay bills? Because sometimes you have businesses that might have assets, but that doesn't mean that that's cash. I want to make sure you understand the difference. The statement of cash flow, basically what you do is that, and again, I'm going to go over every single statement, but they're going to have its own podcast because they're fascinating and you're going to enjoy them. But today, like I said, let's just concentrate on this. You have your income statement, how profitable is the business. You have your balance sheet, how much in assets the company has and how much debt the company owns. And then the statement of cash flows, when I go to the bank, I said, listen, this cash is coming from here, and this other cash is coming from here, and this other cash is coming from here. Because think about it, depending on the type of cash that you get, then you can get a deduction in taxes, you can get different type of things. So the statement of cash flows, which I'm showing here on the screen, just basically gives you the 3 different ways how cash can come in. And again, we'll talk about the statement of cash flows and we're going to do an example in another podcast. So today, all what I wanted to show you is that the income statement, the balance sheet, the statement of cash flows, and then the one that I didn't put here, which is also the statement of owner's equity. This statement, this is the 4th statement, basically what's going to show is the changes in owner's equities during a time period. So the owner's equities will basically show, it can show if you have paid dividends or not to your investors. And I'm going to put an example here on the screen, as you can see. Conclusion. These financial statements are extremely important for business owners, and they're very important also for lenders, because when you go to a bank and you're a business owner and you want to go ahead and, say like, look, I'm capable of making this project with your business. Let's say that, you give them like your business summary and you're like, okay, I really want this money to generate more money. The bank is basically going to tell you, okay, I need your income statement, your balance sheet, your statement of cash flows, and your statement of owner's equity. So now that you understand the relationship between the 4 of them, as you can see here, the bank is just seeing 4 different things. how profitable the business is, how much assets and how much debt you owe, how much cash is the company generating to pay the bills, and finally the owner's equity, how you're treating your investors, how much equity. And equity, what equity is in a business is like, I'm gonna put it this way, you eat a pizza and you bought like a huge pizza with 8 slices, right? And you only ate 3 because you were not hungry, so now you have 5 left. The next morning you wake up and you have 5 slices of pizza. That's your honest equity. Basically, you say 3 were enough, I still have a little bit more, let me save it. You have 2 choices. Obviously, we're not gonna compare pizza with money, but you have 2 choices. Grab the pizza and make your mom happy or your boyfriend happy and be like, you guys wanna share my pizza because I have a little bit of equity here, or you can just eat it for yourself. Or maybe you can sell those slices and say, I'm just gonna use this equity, right, to do something else. So that's what honest equity is. You can also have a pizza that you were very hungry, you wanted to eat 5 slices, but you only have 3, and the next day you open the refrigerator, you have nothing. Well, you don't have any owner's equity. So that's how owner equities could be described in a very simple example. I hope you enjoyed this video. Thank you so much for listening. I will be making more of these videos, and I'm actually going to be digging more into also real estate concepts, because I feel is important, is also fun. So I hope you're enjoying the content and the material. Thank you so much. This is Vanessa Growlish, and I wish you a great, happy Valentine's weekend. This is Valentine's weekend. Thank you so much. Have a good day.